Markets entered 2025 with a familiar story, tech giants leading the charge. But beneath those soaring valuations, a more complex picture is emerging. As bonds recover from 2024's tough run and investors question tech's dominance, today we're asking, is it time to curb your enthusiasm for U.S. stocks? Well, we're going to discuss that and more right now on UBS Trending. Hi again, everyone. Thank you for joining me. I'm Anthony Pastore, and this is UBS Trending. Please join me in welcoming my guest to the studio, Nanette Abahoff-Jacobson, who is a global investment strategist at Hartford. So, Nanette, nice to have you back in the studio.
Oh, it's so great to be here. Thanks for inviting me.
Of course. I think we were just kind of chatting a little bit before we started. We were looking at the range for treasuries, looking at yields and how it's just been, it almost trades like a stock these days for the last couple of years. We're going to get into that in a moment, but I wanted to kind of go into actual U.S. stocks, valuations, and where we sit. Right now, we're in the middle of fourth quarter earnings season. It's looking pretty decent. Our CIO here expects about a 9% growth in valuations based on what we're seeing in earnings. But my question to you is, have we already seen a strong enough run for stocks? Is there more room to go? We were just saying 25% growth in the S&P 500 2 years in a row. Can we sustain that level or even some version of that?
Yeah, I think that the answer to the question, is it time to curb your enthusiasm? Maybe a little bit, but still I'm enthusiastic about U.S. equity markets. And the reason is that the fundamentals are still strong. Whatever is happening, and the political landscape is extremely uncertain. But regardless of that, what we do know is that GDP is solid, inflation is coming down. Yes, it's sticky, and we have concerns about that. But the fundamentals, 3% growth, around 2.7, 2.8% inflation is a good environment for the U.S. economy, and it's a good environment for revenues and earnings. As I'm showing in this chart, U.S. exceptionalism is the running theme. If we look at U.S. GDP versus the rest of the world, that line on top is the U.S. And so that's what I'm hanging my hat on.
Yeah, GDP remains strong. And so we keep looking at that line saying, how much more can we go? We just received the jobs numbers recently that came in also very strong, which makes us sort of pivot again where we think the Fed might be going. 4 was the kind of consensus last year, 4 cuts. Now maybe closer to 2. I think that's where generally most economists are starting to pivot. So it's an interesting time. But back to stocks for a second. We can't get away from talking about the tech names, the mega cap tech names, artificial intelligence. And even from a government perspective, now there's this AI, bill that's going to be going through, like it's, billions of dollars worth of investing in AI. Do you think that U.S. stocks will again be led by these tech names for 2025?
I think we're going to have a mixed shift. I think the tech companies and the mega cap 7, these are exceptional companies. But remember, in 2024, we had more differentiation among the 7. Maybe it's the mega cap 5 now, not 7. And that's because some companies don't look like they're ahead of the AI curve or they've disappointed on earnings. So I think what we're going to see is earnings from that group, at least of the 5, earnings for that group will still be double digit, but it's coming down. And then earnings for the rest of the 495, I think are going to improve with good growth. So as long as we get that growth, then we're going to see broadening of earnings growth. And you see that expectations for the tech, the tech sector, earnings growth is coming down. Earnings growth for the rest of the market is going up. So some compression between those extreme earnings numbers that we saw, because the rest of the market has really been kind of punk, delivering 2 to 4% earnings growth. So what I'm expecting is that to come up a bit.
Right, maybe even out a little bit more than it was in the last year or so.
Exactly.
Yeah, I totally think that's a possibility. And again, as I said, we expect fourth quarter earnings of 7 to 9% growth, and for the year, our target at the end of the year for the S&P is around 6,600. It's sitting at 6,100 now, so it's about a 9%
Yeah.
difference. So not quite 25% like we've seen the last 2 years. But then let's go to the bond.
Anthony, can I add one
I
other
would love
thing?
for you to, yeah.
So that earnings growth, I think one of the reasons behind it is the whole AI innovation trend. That dynamic is spreading from hardware to software
Sure.
to other sectors in the industrial market, in the retail market. So some of those benefits that we saw strictly in the hyperscalers, strictly in the semiconductor companies, that should broaden out to a broader swath of the economy. And that's the other reason that we think some of that gap is going to close.
Thank you for clarifying that, Nanette. I think, yeah, these AI sort of tech adjacent companies, even in the small and mid-cap space, there seems to be opportunity there with those kind of adjacent companies that work with these mega-cap
Yes.
5 AI-related tech companies. So yeah, it's a really interesting picture
Yes.
in the markets right now. But let's go to bonds, because bonds really, it's been, I mentioned at the beginning, almost, I talked to our fixed income folks here and people like you, and I think bonds almost trade like stocks these days. When there was more stability in bonds years ago, you know, you'd have maybe a 25% basis point range in the 10-year in a year. Last year, it was about 100 basis points.
Yes.
We're sitting now with the 10-year at 4.6%. The question, I guess, then goes is, what are your thoughts for the year in bonds? And just to remind our audience again, we're really keeping track of the Fed because of the inflation data and the jobs data. We're thinking maybe the Fed's not going to cut as much as they had originally expected last year.
Yes, yes.
So lots going on in the bond space.
Yes, and I would say that just the conversations, the investment discussions we're having are dominated by two things, Trump and rates.
Right, right.
Because, you know, and they're very interlinked, and we can talk about that later. But the rates market and where rates go, I mean, when rates approached 5% late last year, what happened to the stock market? It was down.
That's right.
So I think the stock market is very rate sensitive. And so whether you're a stock investor or you're a bond investor, you better be looking at 10-year yields, because that's giving you a lot of information. So what information is it giving you? We think that the range in 10-year bonds is 4 to 5.25%. And people say that's a really big range. Yeah. But as you said, the market actually 10-year yields moved 100 basis points 3 times last year.
Yes.
So it's actually not that wide. So why do we have 5.25 at the upper end? The whole question is inflation, will it be beaten or is it going to perk up again? I think that this year the Fed has no reason to ease anymore. So the consensus is for 2 more cuts. I don't think they need to cut at all.
At all.
And I think, I mean, a non-consensus view is the conversation going to pivot to the Fed tightening? Because look, Powell, it's his last year. He wants to leave a legacy of credibility at the Fed. Maybe the conversation will shift to tightening, and that is going to be a big event.
That will be a huge event. And already we've seen volatility at the beginning of the year in stocks based on the rapid rise in interest rates on the bond side. So, yeah, I'm also curious myself as someone who sits here and has these conversations with people like yourself. It's fascinating to see the direction we've taken even just in a couple of months. Right? I mean, thinking about what we thought about the Fed last year, and I asked the question almost every show, does the Fed really have a reason to continue to cut rates based on the data we're seeing, the sticky inflation, the jobs numbers? I mean, it's still a strong jobs market out there.
Yeah, I personally felt that they shouldn't have cut rates in December. And, you know, they did. So the question is, as a fixed income investor, should you hold fixed income at all? I do think you should. Your duration should be a little bit shorter. We talked about the 5-year area for core bond holdings, but I think you need more flexible strategies. You need strategies that can flip duration short to long, and you need income separated from your core bond allocation.
Sure, diversification, right?
Yes.
That's the big word I think that's going to be very important for this year, given, like as you said, with the change in the White House and Congress, there's a lot of unknown variables that are ahead of us, and then obviously with the markets the way they are and the volatility that we've already seen.
Diversification is your friend.
Is definitely is your friend. Yes, absolutely. So where do you think then, if you're someone watching this conversation between the two of us, whether you work with an advisor or not, we hope you do work with an advisor, but where do you think the most opportune investment opportunities are? And we said our CIO also agrees that 5-year part of the curve feels good. Your duration, you're not going too far out, but it seems like it might be a good time to kind of lock in at these higher rate levels if you're a bond investor.
Yeah.
Where do your thoughts go when
Yeah,
it comes
I
to
mean,
investing?
Yeah, I think, again, we're in our portfolios, we're overweight equities, and that is focused on the U.S. We're overweight U.S. relative to European equities. Japanese equities still look interesting to us. Long runway for gains because of the improving corporate governance. So equities is still where you want to be.
Right.
I wouldn't have a big, depending on your tilts, I wouldn't have a big overweight. We have a slight overweight. Fixed income, as we said, I would complement a core bond strategy with some more flexible strategies. And then a non-consensus view is we're keeping an eye on China and emerging markets. Valuations are really depressed in both areas, and China, what everyone says, it's really. Some people think it's uninvestable at this point, but their real estate slump is now in its 4th year, and there are signs that some of the housing data is starting to bottom.
Right.
That would be again a huge event if China started to improve, or if at least the market was responding to the change, which is a positive change.
Yeah.
And that could have ripple effects on EM.
Nanette, always, what a pleasure. I love having you here. Let's get you back in again soon.
Absolutely.
I don't think there's going to be any shortage of things to discuss over the course of the next 12 months or so, because there are so many unknown variables and the markets are pretty volatile. So
Yes.
love to get more of your insights.
That would be
Come
great.
back and see us soon. Thanks,
I
Nanette.
enjoyed it. Thank you.
Nanette Abuhoff-Jacobson from Hartford. Thank you all for joining us. There's more information on our website. Please visit us at ubs.com/views. Lots of great content from our partners like Hartford. Plus, you can follow UBS on social media. We're on all the major channels. Plus, you can also check out our Instagram channel at UBS Trending. Lots of great content there for you. And as always, if you have any questions about what Nanette and I spoke about today, make sure that you are talking with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. We'll see you soon.